The Business Journal Roundtable series is sponsored by Advanced Technology Partners.
Good morning, and thank you for participating in the Business Journal's Roundtable on Wealth Building. I'm George Nelson, Associate Editor of the Business Journal. Now, let's get started with our first question, which, Stephen, you will respond to first. When should someone start thinking about retirement savings, and what strategies would you suggest for someone who is starting late?
Good morning. Thank you. I'd like to thank everybody in attendance here and appreciate what the Business Journal provides to the community as well too. So it's a great question. It's a question that I get often, but the short answer is as soon as possible. You can't begin to first and foremost start thinking about long-term financial goals, but first of all, from a financial standpoint, you should begin saving and investment as soon as possible.
Time magnifies money. So the earlier you begin, the better off you are. We love to work with the families and suggest that they use a Roth for their children when they have W-2 earnings to both educate them and give them that head start. We like to have the children involved. They don't necessarily need to know about the family's wealth, but that particular piece, I think, is a great educational piece, and we like to have the children give input. Better off for the children to make mistakes early in life when the dollars are small than later.
Yes, thanks. I appreciate being invited here today. Yeah, I'd say starting as early as possible is important for everyone, and for those that are starting later, I think there's no time like the present to get started, because it's never too late to start a good habit, which is saving for yourself for the future.
Yeah. Thank you, everybody. It's a great panel. So I'm fortunate to be here. Thanks for the invite. And to echo the sentiments, it's that compounding is the eighth wonder of the world, I think is attributed to Einstein. But yeah, the amount of effort your money has to exert, if you start later, is just way outweighs the amount that money needs to work and earn on itself starting earlier. So the earlier the better. Let it compound and can create futures.
Good morning, everyone. Obviously, I agree with what everyone said. Starting early is best. And also making sure that you educate your clients and educate yourself. Sometimes people are not familiar. Obviously, they've had savings accounts, but they need to understand the risks and rewards of investing in the market and investing in index funds. Becoming comfortable with that, because as Jonathan mentioned, it is important to compound. It is important to grow that money, more than inflation. So educating your clients is best. Being familiar with the market and being comfortable with the returns those markets can give.
Good morning. I undoubtedly agree with everybody's sentiment about starting earlier rather than late, if at all possible. I think the other side of the equation that people often forget is spending habits, and starting to learn healthier spending habits earlier in your career. One of the functions of accumulation is just simple math. Is what you accumulate minus what you spend is what you're left over with. So it is often the forgotten portion of the equation is how much you spend, and thinking about keeping your spending habits in check earlier in your career, or checking those things later in your career and maybe dialing those things back and not getting caught in that lifestyle creep that often prevents people from achieving their goals when it comes to retirement and building wealth.
Thanks for having me, and thanks for putting this on, guys. I do appreciate it. Yeah, certainly the compound interest would be all the more reason to start early. I think being gainfully employed is usually people's first initial trigger. Is once you have a real job or even a part-time job and you have wages, you likely are ready to start thinking about it, or you should start thinking about it. This country doesn't do a great job educating its people on personal finances. So columns like this and conversations like these are all that much more important for somebody who doesn't have our background.
How about addressing helping someone who's starting late in investment? We talked a lot about the need to start early, but what's the best strategies for helping people who are starting in their maybe 40s or 50s?
Brian, I think was it you who said it? There's no time like the present.
Yeah, I would say there's no time like the present. I think as people get closer to retirement, I think it's even more crucial that they think about their own selves in the future. Save for yourself, so to speak. Think of your future self and say, how much money do I want to have when I do retire, or if I want to retire, and start saving for that day. And the sooner the better. You can't change the past, but you can always work toward the future.
I think the other comment to make when you think about someone that maybe waited a little bit too late to get started is having that difficult conversation about some of the adjustments that they need to make to their life, and not being afraid to tighten their belts a little bit and maybe look at how they're spending money. Are they, overspending at home? Are they overspending on vacations? Are they overspending with too many cars or too many timeshares or this, that, or the other thing? And really take a step back and look at their plan and think about the math that's going to be required to get to their end goal and make those adjustments sooner rather than later.
Yeah, I always like to say, if you don't know where to start somewhere, start anywhere and move forward, right? So, I think it's really easy to put it aside and put it out of mind because maybe you're anxious about the fact that you didn't start earlier, but to kind of dissuade yourself from that and to just start somewhere. The habit ends up being the hardest part. And if you could get rolling and get moving in the right direction, then you can start making those adjustments, like Tim said, start to reevaluate some of the decisions while balancing the present with the future. And it's really, it's amazing how quickly you can get somewhere, start to build that confidence, and then start to move forward.
How should someone strike a balance between risk tolerance and financial goals? How should that change as someone ages?
I think changing as someone ages is a much more complicated concept than what's been talked about in the past. Everyone's in a different position. If they've got significant assets, it may not need to change as much. If they have a pension, it may not need to change as much. But finding the comfort level for an investor is one of the most difficult things we have to do. If we're too aggressive, they're not going to stay in a period like what we just saw a month ago. And if they're too conservative, they're going to leave too much on the table. So finding that level is really one of the most difficult things that we do, and then keeping the client in a period like a month ago. I'm sure everyone at this table was not enjoying themselves at that point, and trying to make people comfortable. That was a very significant policy shock. But the clients that were able to stay with it succeed, and that's our job. We've got to find that match.
I believe sometimes there's actually even a misconception about age and risk tolerance. Some of my, let's call them elderly clients, as the saying goes, they forgot more about investing than a lot of people even know today. They are shrewd investors. They understand market volatility. While we don't like it, no one likes those types of things, but some of my more experienced investors, they have usually the most conviction. Ultimately, I try to tell people also, truly understand your investments, what you own, but just as importantly, why you own those investments also. It can be very cliche to be a long-term investor, but you really have to understand that and fundamentally understand what your investments are. But like everyone I assume here would agree with, we do understand a lot more about volatility as we become more and more experienced as an investor. And as you go through episodes, most recently is another example, I think we just all become better long-term investors as a result. So I think it's an evolving process over time where you balance the risk versus the reward, but most importantly, I think goals-based financial planning is most important. Truly understand exactly what you're investing for, why you're investing and what the underlying investments are to accomplish those goals.
I think too, diversification is important as well. So if you, to, Steve's point, if you, work with a client and you tell them how they're invested and how diversified they are, so they don't have, per se, all their eggs in one basket, I think that's important for them to understand that they are not exposed too much to any one sector that might be volatile at that time. So, I think that's important, just working with your client, having those conversations, reaching out to your client, being proactive when you have periods of volatility, like we had about a month ago. So reaching out to your clients and making sure that you reassure them, that you are in it for the long term and you are diversified and this is what you're invested in. And, I think that bodes a lot to the client's confidence.
I think striking a balance between risk tolerance and goals is critically important before you even start to invest. So you should list out your goals, your objectives, your risk tolerance, your tax situation, and then you design the investment portfolio so that if you have a high risk tolerance as an individual and you're willing to ride the market up and down, that's okay, especially if it's longer term money that you're not going to be touching for 10, 20 years, like a 401k or IRA or Roth IRA, or money that you're just setting aside for your future. However, as you age and you start to pull money from those funds, you're no longer working, let's say, and you need to withdraw from those funds, it's a time to reassess again and determine, is now the right time to have that higher risk tolerance? Because if the market pulls back 10 or 20%, you have to pull money out, are you liquidating in a down market, which oftentimes clients may not want to do. So it's something that needs to be reassessed all the time on an annual basis, I would say, at least, but especially on pivot points when you hit milestones such as retirement or if you're just starting to save.
Yeah, and to build off of that, Brian, I think that the risk and age have this symbolic relationship, but it's not necessarily that easy. I think we have plenty of 80-year-old investors who have money that maybe is likely a legacy asset. And that money doesn't have to be invested as if it's needed for income within the next 10 years, right? If it's maybe the next generation's money, and that's the goal or the most likely use, it should be invested with that risk profile. And I really like to look at risk in two different ways. There's risk capacity, which is when you're assessing the textbook version of an investor and what their propensity to risk is based on the use of the money. And then there's risk tolerance, which is a deeply personal thing. Can I weather rides? Can I handle it? If I see a ton of volatility in my accounts. And I think good advisors, good planners kind of have to marry those two things. We know what the textbook says we can do. Here's what we know about you and your ability to ride the path. I think, Sid started this conversation with that. A plan, no matter how great it is irrelevant if the investor can't stay disciplined to that plan when it gets difficult. So marrying the risk tolerance, which is internal and personal, with that capacity is really the best link, in my opinion.
I think that's well put, and I would add cash flow analysis is extremely helpful. You need to know that you have your needs covered. If you have your needs covered for the next year or 2, 3 years with cash on hand and cash flow, that makes this a lot easier to show the client and to ride through those periods.
What are some effective wealth building strategies for the long term?
The stock market remains the biggest wealth generator on the planet, particularly in the U.S. So just as a concept, finding a way to participate in that. Typically, the wealth building for the long term, you want to use tax advantage strategies, right? And those could be IRAs, 401ks, HSAs, things like that. But those all have limits to it as well. So you're making more money than you know what to do with. You're maxing out your retirement accounts. Sometimes you can't always be strategic with how you do it from a taxable perspective. But certainly, and I'm not saying it's the only way, of course, internal businesses, a lot of people are successful in real estate. But it's certainly a great avenue for people to build and accumulate wealth that's beyond the average rate of inflation.
I think the best wealth building strategy is to avoid making emotional decisions. When you make the poorest financial decisions in your lives is when you make emotional decisions, when you buy things that you think you need to buy because you're filling some emotional gap in your personal being. I think when you exit the market too early in times of volatility, it's an association of an emotional decision. So you should be working with your financial advisors to help you avoid making those emotional decisions. And if you can do that over and over again, you'll make good, solid, logical decisions. Those things will compound, and you will inevitably accumulate wealth as a result of that.
I think staying disciplined as well, staying disciplined, making sure that you know, do continue, if you have an account that you set up for a savings account to build, you know, your emergency fund 3 to 6 months of your budget for that month. I think it's important to stay disciplined and put that money away as if, you know, every month with it, whether it's your 401k savings that you're putting, you know, 10 to 15% away, and the same thing with your after-tax savings. So budgeting and staying disciplined, I think, also helps to that point.
To not repeat what everybody else said, because I agree with all of that, it's, and I know Tim will agree with this too, it's not what you make, it's what you keep, right? So having a tax lens on decisions as early as what container you're saving in. You know, $1 million pre-tax IRA is not $1 million, right? It has a liability associated with it. $1 million Roth IRA, you know, is $1 million plus. You get every dollar you earn on that is tax-free. So having that, you know, having that tax lens to wealth generation and wealth building and making those good decisions, you know, earlier on in your savings, you know, could make a big difference down the road.
Now, I'm just curious. Several of you have mentioned the volatility of the previous month. Did you have many clients that responded, okay, I don't have this kind of risk tolerance, I need to get out of this? What did you do to kind of talk them down, and how successful were you at that? Or did they pretty much have the perspective that, yeah, this is a blip, we'll get past it?
I would say maybe not as framing it as much as a blip. I think a lot of people were uncomfortable. It's cliche these days, but just managing through the uncertainty. And at the end of the day, no one had any certainty for that matter. But I was very proud of our clients, how resilient that they were. Very few, as we kind of say in the industry a lot of times, incoming calls. We try our best to be very proactive. I think part of the seasonality of that volatility was it was also tax season, and I can speak for myself. I may be on the periphery of tax season, but we're very much involved. So I think people's attention were on a couple different subjects, but I really believe in these last several years to decade, it's one of those things where I think volatility is probably going to be with us for the future as well. We've gone through some historical times just in the last couple years alone. So I was actually pretty proud of how investors reacted. I had very few people that were looking to bail, so to speak. In fact, most of the clients that we were talking to were looking at it opportunistically and looking to add funds, understanding back to what most of us have been saying. Investors today, I think, are pretty educated. I think they understand what they own, and more important, like I always say, why we own these things. And at the end of the day, the fundamental reason for owning the investments that we own, it made some sense to actually add to them.
This is a very politically charged time. And for the last election cycle through now, people have been conflating investments and politics. And politics and profits don't always go together. If you were pro-Trump, you were negative on the market last year, the people that are extreme, and vice versa. We have a new administration that's come in, and the changes are significant. And these are things you need to remind people of. Politics and profits should not go together. CEOs make a great deal of money to try to navigate the times that they're dealing with. There's a reason you saw so many of them make the migration down to Mar-a-Lago. They're doing the best they can for their shareholders. What happens generally with a change in administration is a change in the winners and the losers. Deregulation, for instance, which has been touted as a hallmark of this administration, will benefit certain industries, like banking or industrials. The tariffs will hurt other industries. So it's talking through things like that with clients. And if you note what's gone on recently, we've had a lot of retail buying with hedge funds selling. That was particularly notable in the last week. So, we need to remind our clients that we're not playing the same game as the hedge funds. We're investing for the long term. We're making adjustments as they need to be adjusted. It's like taking a trip. You try to avoid the bridge on 224 perhaps, but you lay out a path and you try to stick to it, and you don't change based on whatever you're hearing on the radio.
Sorry, I would just add, in peak uncertainty is a really awkward time to start the risk tolerance conversation. Hopefully a neutral environment is a great time to start to look at what is my tolerance. And then when peak uncertainty presents itself, it's always around the corner. We don't know when. That's when folks, I think, in my experience, need reminded of what the long-term plan is, and to stay disciplined to that long-term plan, and to not make short-term emotional decisions with a long-term plan.
How much should someone save for retirement? Is there a rule of thumb that you recommend to your clients?
So I think the part that people tend to forget when it comes to this conversation is the harder question is, how much do you need? Because the answer to that is different for every single person probably in this room and everybody that's planning for retirement. That takes a lot more time to assess. What is the annual living cost that you're going to not only need to live, but the annual living cost that you want to have? And once you understand that, once you understand what that annual living cost is, it's much easier to back into your target. So we typically start having that conversation with our clients alongside their financial advisors to understand, what's that number that you're going to need to live comfortably, and then work our way backwards and say, okay, the rule of 5% says that, if you need $500,000 a year to live, then that means that you've got to have $10 million saved. And if you can peel off 5% of those funds every year, then you'll be largely safe over a period of a couple of decades. But I think the most important part that a lot of people forget is they just save. They make sacrifices to the quality of their life to try to accumulate as much as humanly possible. But in reality, they oversaved, and they made sacrifices to the quality of their lives and time with their families over the period of their earning career, and save too much. And then at the end of the day, when it comes time to retirement, they have all this money and they didn't use their time properly over that period of time.
Mm-hmm. I couldn't agree anymore. Always keep in mind the end goal in mind, but just to your point, I do think people, especially new, getting started, I do think sometimes rules of thumb can be applied, but I try to set the bar pretty high for people. I look at myself as kind of like their financial fitness coach, and why not kind of come out of the gate pretty strong? But I would say a general rule of thumb is 15%. Another way of looking at things is having 10 to 12 times accumulated savings of your last additional years or your last several years of salary. Again, these are just benchmarks to go off of. In the camp with Tim is just kind of trying to be very, very personalized. But at the end of the day, when I'm just kind of generally speaking to folks, especially a lot of times clients are bringing their children through, and sometimes the children are listening to us a little bit more than they may their loved ones. but I try to set aside those rules of thumbs as benchmarks.
How can someone build wealth while minimizing tax liability?
I think the easiest way is to have an ongoing relationship and conversation with both your tax professional and your financial advisor. I think it's very important that those two pillars in your life are communicating on a regular basis, sometimes even without you. Most of the people in this room I have a very personal relationship with for our clients. When they're thinking about making a big move in the market or realizing a gain or reallocating a portfolio, they're staying in touch with us. We're adjusting things from a tax perspective and saying, hey, we have this loss to consider, or we have this other life event that's happened in this business. So if you can ensure that your financial advisor and your tax professionals are constantly in some form of communication, then you can minimize the risk that you're giving away any extra of those dollars to your favorite uncle.
Yeah, there's some, fairly thoughtful and sophisticated ways to minimize tax inside of investment portfolios. Vanguard did a study, I'm sure a lot of people on this panel are familiar with, the Advisor Alpha study, that identified that there are tactics that you can do. One of them is asset location, where you're just parking the right assets in the right containers. That can add up to, in this case, 0.75% to your annual return by doing so. So I think when we look at investing, it's, as I said earlier, it's not what you make, it's what you keep. And there are tactics, particularly in the non-qualified side, of the investment world, to where, you can tax manage that portfolio in times of volatility, doing things like loss harvesting, where you're pocketing, you're getting something out of the volatility by pocketing losses, carrying those forward and netting those against future gains. There are a lot of things that one can have done inside of a portfolio that keeps that net as high as possible.
Great comments. I would say relationships that I have, the strongest relationships that I have, the most experienced clients that I have, not only am I part of a trusted advisor to them, but there's also a team approach, and a team approach is going to be your tax preparer, a lot of times various types of attorneys as well too, and it's very rare where we're making large planning decisions without kind of the group discussing that in detail. Again, during the volatility, and it was tough because it was also tax time, but we took advantage, as Jonathan was talking about, tax loss harvesting. Also took advantage of a lot of Roth IRA conversions during that period of time too, but I would not have made, especially on the Roth IRA conversion, I would have made those decisions on my own without consulting with the client's tax advisor, especially, just because those are pretty big decisions. And it's best to have as many minds and the clients in comprehensive team involved in those decisions.
Yeah, I like to say we're tax knowledgeable, not tax professionals. And if you want your portfolio or whatever your situation to be most optimized, you take the team approach, just to kind of what you said.
I think one other tactical point that's worth expanding on that Jonathan mentioned is if you're solely focused on just putting money into your 401k and not putting money into a brokerage account, putting money into a Roth portion of the 401k, then you're going to have a lot of limitations when it comes time to taking that money out later, which could cause tax problems in and of itself. If you only have money into a 401k, and let's say that one of your children is getting married and you need to take that money out of somewhere, and the only place that you have to take it out of is that 401k, that additional taxable income that you're taking onto your tax return that year could cause other issues, could not only cause you to pay more taxes, but could put you in a situation where now all of a sudden your Medicare premiums are higher or your Social Security is more taxable and things like that. So sometimes it's just as important to consider where you're starting with those dollars and what you're allocating into those buckets, into those containers, as Jonathan mentions, to ensure that you're in a position where you can pull the money out in the most tax efficient way possible later.
What are some common pitfalls encountered in wealth building? For example, oversaving was mentioned earlier, and that wasn't something that I would have considered.
Well, there's two components to what we do. What we do for people is we plan and we optimize, right? So that could still be a good plan. And I think that's, to your point, I think that's what you were trying to say is oversaving isn't a problem in it of itself. You're able to accomplish the things on your list that you want to accomplish, but it's not the most optimal way to do it. You're pulling from resources, you're going to have RMD problems, you're going to have liquidity problems if you overstuff your 401k, and you could still get the money, but you have 10% penalties and ordinary income taxes on a traditional withdrawal before 59 and a half. So again, there's a large component of what's the most optimal decision to reach our overarching plan.
I think too, emotional investing. I think, again, what we saw during COVID with the 30% drop in the market and people wanting to pull out, last month with the tariff talk. I think a lot of clients, what they do is a mistake, and what's a pitfall to them is that they see these, spikes in volatility, and the first thing they want to do is, for those maybe that aren't as seasoned investors, the first thing they want to do is take the money out to preserve that money, even though they may have already lost 15% of the account value. So I think emotional investing sometimes can be a large pitfall to a client, that's not as sophisticated in the market. So I think that's a financial advisor's job to kind of talk them off the ledge a little bit and explain to them, that volatility is normal, and it actually creates sometimes an opportunity to possibly add dollars and show them that they're well diversified and educate them on their portfolio and what the long-term investing is all about.
We're going to constantly go through periods like we did last month in one way or another, and they're always different. Interestingly, last month, the VIX volatility index exceeded the level we had during COVID. That's how extreme the concerns were at that point. We had 2% and 3% market moves each day. So I think Stephen's right about emotions. You want to try to take emotions out. You want to remember what your plan is. With regard to oversaving, I think you have to build towards your goals. And what are your goals? And think about it. The happiest clients we have are not those that look at their portfolio value as a scorecard, but they look at it, money as a tool. It's there to take care of themselves, their family, and the things that are important to them. These are the people, I think, that are truly the happiest.
I would say one of the pitfalls is not having a plan. If someone doesn't have an investment plan, because then they can be driven by emotion. They can be driven by trying to time the market versus, and there's the old adage of it's the time in the market, not timing the market. There's always volatility, but if you have a plan and you stick with that, it works out in the end oftentimes, as long as it's a good solid plan where you're working with your outside advisors, the attorneys, accountants, financial advisors to make sure your plan's in place. And I think that as long as you're looking at it from that perspective, you can shut out the media, so to speak, the CNBC where the price is up there every single day, you can see your net worth, versus when you own your house, you drive up to it. Some days if you had a market value when you pulled up to it, you'd say, oh, it's a great day. And other times you pull up and say, wow, it's a terrible day because it's not, the value goes up and down. And the problem with technology today is we can see our value every single day if you really want to. So shutting that out and saying this is planting a garden for the future and letting it grow, that's the best way to avoid those pitfalls.
That's really well put. It's the old expression, you're not seeing the forest for the trees. I think today we are almost looking at the bark, we're not even seeing the tree. The technology has changed all that.
Just to pile on, I'm talking about common pitfalls, lack of diversification, emotional investing, neglecting to plan for taxes, failing to adjust financial plans as circumstances change, everything everybody talked about. But I would say diversification is paramount, and over the last couple years, there's been truly just a couple of leaders, just for example, in the Standard & Poor's 500 that have been the dominant market participants for the last couple years. So I think clients just sometimes think they're a little bit more diversified than they are, and then you go through some bouts of volatility and you understand it a little bit more. So constantly taking an x-ray of your investments also to understand diversification truly, and making sure that you have proper diversification across asset classes.
Yep, and I would just add really quickly, because I agree with what everybody has said here, and just on a more technical note, I think I've seen a lot of investors struggle with the distribution game. They've worked and saved their entire lives, and they've gotten to that point, and they're just pulling from the wrong assets at the wrong times. This goes back to what Tim had mentioned. They're triggering IRMA, Part B costs without really knowing it or being aware of it. And so there's a ton of opportunity on one side to managing that distribution phase well, and optimizing your tax brackets at the point in which you're distributing. And the other side of that is there are a lot of pitfalls that you could just stumble into without even knowing you're walking into it.
One comment from maybe a slightly different perspective is that I think that people have a correlation that financial health and wealth are the same thing. And financial health and wealth are not the same thing. Financial health is a component of wealth, but wealth factors in so much more. Wealth factors in time, wealth factors in physical well-being, wealth factors in obviously that financial health piece as well. So I think everybody should have a different perspective and different definition of what accumulating wealth truly means. Accumulating wealth might mean showing up to every single sporting event that your child is participating in. Wealth might mean to someone else having the largest balance in their 401k. So I've had the luxury of meeting a lot of successful people as being an advisor at a CPA firm, and there are plenty of people that have a huge balance in their 401k plan, but are not by definition wealthy because they're miserable. So I think that that's something that a lot of people forget, and that's a big mistake that people make in that accumulation of wealth, is just trying to stack as many dollars up as possible and forgetting about all the other things that are so very important.
Is there a particular strategy or approach you suggest for annuities versus stocks versus other investment vehicles? And how has that thinking changed given the market volatility that we've just discussed, that we've seen over the past several months?
I'm personally not a fan of annuities. A lot of our clients are wealthier, and they're a difficult asset when they have to be passed on to their heirs. I like to keep things very simple. We run models. There are individual bonds on the models, and there are individual stocks. You know, we run tax-efficient overlays on the equities, and really just work from that standpoint. I think simple building blocks with a proper plan and a discipline, it works.
I would say every individual circumstances are different. There could be a place where an annuity makes sense, potentially for guaranteed income. I think looking at the individual, looking at their circumstances, and truly tailor-making investment portfolios around that. But at the end of the day, it's diversification. You've heard that common theme over and over again, but sometimes it could be an annuity approach. Sometimes it could be individual equities. Sometimes it could be just fixed income portfolios. So I really truly believe that I don't have clients that have the exact same portfolios over and over again. Maybe philosophically, there could be some core similarities to investment portfolios, but it's truly on an individualized basis.
I would agree with that. I mean, the instrument is almost less relevant, than the investor's comfort with it and their ability to understand it, particularly when times are tough. And so being able to, there are certain instruments, certain vehicles that are just more tax efficient that you want to own, in non-retirement accounts, ETFs, individual stocks, municipal bonds. There are certain principles there, but I think at the end, the investor has to be able to appraise their portfolio, understand it enough to believe in it when times get tough. It's really easy to believe in a portfolio when everybody's making a lot of money. And it's really when the scrutiny comes, when people are nervous. And that's really when you want, and that's where I think you look at, something like an annuity, which, you do have to understand what it is enough to understand its drawbacks. I think sometimes as a behavioral tool, some investors might, require some different comforts. So it's very individual. But you need to understand what the drawbacks of something like that are as well.
This circles back to part of our discussion earlier. At what should parents and educators be teaching about investments and finances in general? And at what age should be teaching this to these children?
I think soft skills is probably the biggest one, as in basic budgeting, basic understanding of the market, basic understanding of taxes. We've all taken planning your financial future or something just like it in college, right? I feel like that should be pretty much just that class should be accessible at a high school level, not even a collegiate level. Like, it's kind of, sorry for the hot take here, but it's crazy that I had to learn about weather patterns, but I didn't learn about taxes in college. I had to take my core classes to learn that. I know it's kind of a cop-out answer, but anything start small and start at a broad audience, because people have to go out of their way to find financial education, and there's so much miseducation out there, especially now.
I'm a financial advisor and I work at a bank, and my kids didn't have a savings account until they started working. So that was my bad almost, that I didn't start them earlier, because I do think that if you do have a child that's young, that they are doing chores and you are giving them, some type of compensation for them to do those chores. To do those chores, I think it's important that they learn, the value of money and budgeting and understanding that they do want to buy something, they have to save for it. So once I started the savings account for my children and they got to see their, online accounts and what they're spending money on, and we went through their budgets, I think, that makes sense, that starting earlier, because now they're a little bit behind the eight ball, but it's never too early to start, but it's never too late to get your child involved. And understanding, what I do and understanding investing. They also I started a custodial account for them so they can see, we started it with a pretty basic S&P 500 index fund, and them showing them, putting $25 a month into that account and showing them how it grows and giving them online access and showing them the value of money and them being actually excited about seeing their values grow. So.
Yeah, and kids are wonderfully curious, and and you can cut this if you want, but I have a 9-year-old, and he is obsessed about starting a landscaping company someday. He's been obsessed since 3 years old, and it's so funny. You'll think I made it up because of the question in the panel, but last night after I tucked him in, he started to just ask me questions about, Dad, how do you start a business? Is there a lot of paperwork? And he starts it, and he's thinking about it from this landscaping perspective of, can you start with one garage and then add a second bay someday? And I say all of that to say, kids are amazingly curious. I wish some of my clients asked those kinds of questions, frankly, because the older you get, the more secure you are about, what you know and what you don't. But I have always taken the tact of trying to talk to our kids as if they were an adult and let them ask the questions. And you'd be surprised at how you can instill some good habits that way.
Great points by Jonathan and Linda. I would say, again, rules of thumb, I don't think 10 years old is too young to get started, but just talking about basic comments or concepts. Linda, I like what you said too, and it's something that I've actually adopted as well too. I personally believe in sharing, whether custodial accounts, 529 plans. I like educating the children about what they actually own. I think a lot of times they get excited. If you humanize investing for them, ask them just simple drills, go through the pantry in the home and turn around those cans or those boxes and actually look at the companies that manufacture those goods, or what pair of sneakers are they wearing, or what type of technology are they using, where do they source their music, things like that. And just simple drills. I asked them to visualize driving up and down 224 here in Boardman, and I asked them to rattle off some of the marquee signs that they remember. And so they'll start mentioning some of those names, and I'll tell them, look, that's a publicly traded company. Those are companies that you can invest in. So I think a lot of times they don't realize that investing is part of our everyday life too. So, but basic concepts, again, budgeting is incredibly important, just saving, which you try to instill that whole concept of delayed gratification.
So I have two children. I have an 8-year-old and a 6-year-old, and I often think about this conversation, and started very early thinking about this conversation with my children. And think about the conversation I have when we're speaking at high schools or colleges with other students. And there's really 3 areas that I think are the most important when we're talking about educating our youth about their finances. I think that number one is teaching them mindfulness. I think that if you turn on the TV and watch TV alongside your children, you understand that they're constantly under attack about what someone is telling them or encouraging them to buy. And teaching them to understand those tactics at an early age. My son and I will watch the NBA playoffs, and he'll see an advertisement and he'll say, that's them trying to convince me to buy this at an early age already. I think that mindfulness is important. I think that teaching our youth the importance of credit is extremely important. That was something that was beat into me by my family members as I was growing up, and I think that it's a tool that is underutilized for kids. I think that our country encourages people to spend more than they make, but if we can continue to teach people the importance of credit, then they'll be in that much better of a position when they start off, because often those early mistakes and those early decisions that you make are then compounded over the course of your life. And then finally, I think the importance of teaching people the difference between what truly is an asset and what truly is a liability. And understanding the things that you can buy that will provide for you into the future. An asset is a tree. An asset is something that will grow fruit for the future. And a liability is something that you have to pay to maintain over some period of time. So there's often a mix-up as to what truly is an asset and what truly is a liability. So focusing on those conversations at an earlier age will provide for people to not be digging themselves out of a hole later in their financial lives.
How should someone create a nest egg from an inheritance, court settlement, or other windfall they receive?
I think possibly the first thing they should look at is, if they do receive an inheritance or lottery winnings, is to take a breath and take a step back a little bit, give themselves some time, possibly just kind of park those assets in a high-yielding money market or savings account, and then just kind of evaluate, surround yourself with, a trusted financial advisor, a trusted CPA, an attorney, possibly get some recommendations from family members who they work with, even interview advisors and CPAs to make sure that you're comfortable with that they have a plan set in place for you. I think, that's probably maybe the first thing that I would do, is just kind of take a step back, take a breather, and kind of evaluate where you are and surround yourself with good people.
Yeah, get the dream team together, right? If you have outsized wealth, if you come into outsized wealth for the first time in your life, it's going to be unique to you. And it's kind of like exactly what you said. Get your accountant in order, get your estate plan in order, because hopefully they had their estate plan in order. That's how you got the inheritance in this case in the first place. So make sure you have that, and then make sure you have a financial planner at your back. Get the dream team together and let those people put their heads together, come up to good solutions for you. You probably should, especially after a loss. I know a lot of my clients will take time and just keep everything as is, and then when they're ready to talk about it 3 to 6 months later, the estate's settled, things like that. Lottery winnings is a little different. I'd say go to Vegas for a little bit of that or have some fun, but no. So certainly, get the dream team together, I guess, would be what I would say.
Having a plan consultant with a team, obviously different types of circumstances, but Tim talked about it a couple times, and I couldn't agree more. Truly evaluating what your liabilities are. I would say the first thing would be to consider, I agree, not making an emotional decision right away, give some time, let some time pass, but paying off high interest debt, and then also reflecting how you accumulated that debt. So sometimes with inheritances, especially, some of those folks do have those situations where there is some debt and we end up paying off the debt, but then they could fall into a trap of just accumulating further debt after that, just based on habit. So I think it's truly reflecting where you're at in life, making an honest assessment about those things, working with a team, and just trying your best to stick to some type of plan.
Yeah, I found the investor's psychological relationship to windfall money or found money is in my experience different than the I've saved paycheck by paycheck for this money. Their own retirement savings or otherwise. And I think that understanding that emotional relationship and psychological relationship that clients and investors have with their money is very important. And being able to take a windfall and translate it into what's possible for that investor is very important. Money has a variety of jobs. I think, Sid, you may have mentioned that earlier, and identifying, okay, this part of this windfall is going to be your baseline lifestyle. This part of your windfall is going to be the legacy that you leave someday, so on and so forth. Going through that building of the plan and then having that investor plug into that psychologically so that they don't view it all as found money, because the statistics on what investors do with found money are generally not great.
Okay, we are knocking on 9 o'clock, but I've only got 2 more questions that I think we can probably get through without going too much past the top of the hour. So first, what should investors consider when leaving their assets to younger family members? And how about leaving wealth and assets to a nonprofit or creating an endowment?
I think if the process has gone right, the younger family members are relatively educated already. You definitely have to work, I think, as Stephen and Tim have both said, you want to work with your accountant and your lawyer. You need to be in concert there, understanding what the overall net worth is and how to utilize trusts, which could be quite important. What we see a lot is maybe an irrevocable trust is used at the parent level, that then flows into an irrevocable trust for the children that moves along a bloodline, for instance. My daughter, very proud of her, a school teacher, but there is a trust in place for her and to take care of her husband, and her children. If they're divorced, that money will stay with my daughter and her children. If she's gone, then that money is there to support him and the children in all their efforts. That type of thing, I think, is extremely important to set up right from the beginning.
I think when leaving it to younger family members, such as children, you got to think about their age, their ability, their needs, and factor that into your plan, which should be looked at on an ongoing basis. You won't set it and forget it, because as they age and their lives change, it needs to change with them. So I think it's an ongoing process that you factor in the need, ability, and their age. But then, as dovetailing that into how do you give to a nonprofit, I think it's an excellent way to give back to the communities that have given so much to us and to the individuals who are making those decisions. And it's a great way to teach your family about your philanthropic ideas and beliefs of giving back to those who aren't as haven't had the abilities that others that you may have had. So it's a way of teaching them to give to those who have needs that they may not have.
Yeah, this is a great to get technical. This is where money type matters. So having a plan, particularly at retirement age, of understanding, and you can know with You know, of course, there's uncertainty, but you can know if there's a likelihood of a legacy, and you can do things then when you're, say, 65 to prepare assets to be best inherited. And the easiest comparison is a pre-tax or traditional IRA versus a Roth IRA and how that's inherited. You know, a Roth IRA, to speak to the good, gets inherited free and clear. So if you're talking about the next generation, and they have 10 years to continue that tax-free growth. Whereas a pre-tax account, if inherited, they have 10 years to take it out and pay tax on it, which oftentimes overlaps with maybe your child or a younger generation's highest earnings years, right? So, you know, money type can matter with these types of things, and you can look at the plan and say, okay, we're going to take your Roth assets, and those are going to be your legacy assets. We're going to crank up, you know, investment because it's longer term, and we get tax-free growth in that container, right? You know, and that's a really, I think, in my opinion, a smart thing to do. And, you know, pre-tax money, you know, great for income, also not a bad thing to give to a charity because charities don't have tax liabilities. So, you know, understanding what the job of your world is, of your investment world is, and kind of giving them jobs is going to be important here.
I'd say investors, they really have to understand the financial maturity and responsibility of also younger generation, and then quick pivot to philanthropic endeavors as well. I really think it's important to understand the mission of the organization, and a lot of people don't want to admit, but it's vital to look at the financial stability also of that organization for sustainability, and also the impact of what this gift is going to go for as well.
Our first question, we started with Stephen VanSuch. This final question, we will start with Stephen Daprile and go around in the reverse order. What points would you like to make that have not already been discussed? Any final thoughts you'd like to share? Stephen?
What haven't we brought up? I guess I'm drawing a blank. I got nothing. You guys got anything? Too much pressure to go first.
Go ahead, Tim.
I think that we've talked a lot about having a plan over the course of today, and I think that the relationship that people should have with their financial advisors is similar to that of a personal trainer. And Stephen made a good comment about that earlier, is that this is the person that you should be going to hold you accountable to this plan. They're going to prevent you from making too many sacrifices. They're going to prevent you from overspending or from doing things that you shouldn't do that are going to be difficult later along the path. I think that one of the things that we've seen with a lot of our clients is that if they have a good plan, they can use their wealth and their finances as a tool to not only make their life better, but make the people around them's lives better, or their community better. They can consider things like, if I have a great plan and I know what the end game is like, I can give these dollars to my kids earlier, and I can make a bigger impact on their lives now. I could pay off their mortgage today so that they have less stress and they have less trouble today, rather than them inheriting a bunch of money when they're 70 or 80 years old and they can't necessarily enjoy it. So making sure that you start with the end in mind, and using that financial advisor as that coach, as that person that's on this journey alongside with you, is something that's really important and underutilized.
I think with the way technology is today, and a lot of the younger generation being comfortable using technology and investing in, you know, for themselves, to Tim's point, you know, when I started in this business over 30 years ago, it's, you know, your financial advisor was everything. They didn't have the online trading, the e-trades, the Robinhood, things like that. So to Tim's point, to keep yourself in check, sometimes you're going to need that help. You know, you can buy an S&P 500 fund, or you can buy a stock here and there. But I mean, really, I think it's important, just because of the knowledge base of a lot of financial advisors out there, you know, they can help you avoid those common pitfalls that people make, as maybe not diversifying enough, putting all their, you know, money in one stock or, just the Magnificent Seven or whatever that would be. I just think that it's important, to take a step back and thinking that you can do all these things on your own and investing on your own, which you can at a certain point, but then it becomes important to pull an advisor in, to help you keep on track.
Yeah, I think having a plan, in my opinion, having a plan is what unlocks what's possible for an investor. And, I think it's easy to assume that this panel's job is to make sure our clients don't run out of money. But I would argue that our equal and other job is to make sure that the client doesn't leave a massive amount of money if that's not what their desire is. And so our job ends up being managing these two guardrails. And in between those guardrails are kind of the best life for the investor. I think it's the average investor, by the time they're 80 and they've accumulated, they probably can figure out whether or not they're going to be okay. And I think our job is to pull that earlier in their life when they have the time to do the things that they love and that they're passionate about. So being able to give them the confidence when they're 60 that they're going to be okay and they can do the things that they want to do. That's where a plan really unlocks the potential.
I would say the key word would be education. Everything we've talked about today is good for anyone to learn about, to teach their spouse about, to teach their children about, because you can work hard and learn all this information, but it's also beneficial to pass it on to others that will inherit this wealth someday. So I think it is important to educate, because there's experts in various areas. These are experts, we're experts in one area. A lot of our clients are experts in areas that we're not. So to educate themselves on this, their spouse, their children, and that way it maintains the wealth and helps them understand how best to take care of it and to use it to the benefit of the greater good.
I think Jonathan and Brian are both absolutely correct there. If someone is generating wealth, again, they're taking care of their family and the things that are important. There should be an educational component on our part, not only to them, but to their generations. And that educational component should help not just that family. For instance, those with excess wealth, things like donor advised funds or foundations can be established. These are great ways to not only help the community, but to teach the children about what's important beyond their own lives. And I would venture to guess that everyone at this table has done what you would call pro bono work, is talk to a friend, a neighbor, a relative that doesn't have the financial means. And probably every one of you has helped their lives be better by doing that. And I think that's important.
At the end of the day, having an end goal, and I would also add a purpose in mind. I would say that's probably the number one mistake I see on the front end, is just not understanding at the end of the day, take a step back, what are we trying to accomplish here? Then I would say monitor that progress, not daily, but monitor that progress. And then lastly, be flexible as well, because sometimes whether it's an annuity or whether it's an exchange traded fund, whether it's an individual stock or bond or mutual fund, but always giving yourself the flexibility to make changes in your personal assets as well. And I think it was fitting also that I kicked off the roundtable. You maybe intentionally put me in the hot seat next to the toaster here, so I don't think I came out of the gate strong, but again, thank you for the positioning here.
Can I throw one more thing out there real quick? One thing that I wanted to talk about, because it affects my generation, so just bring it up real briefly, I know we're wrapping up here, is reading your news from a quality news outlet. My brother's a journalist, and he's been pounding this into my head, so a lot of people my age have a lot of misinformation at their disposal, and they just eat it up, and it drives me nuts. It drives me crazy. So read your news, read local, but certainly when it comes to, for the sake of the panel, when it comes to reading your financial news, make sure that you're trusting quality news outlets. It's so fundamentally important. I think most of your generations get that. I think it's lost on mine. So just wanted to bring that up.
It's a great point.
Thanks to all of you for participating in today's panel, and to Advanced Technology Partners for continuing to sponsor our Roundtable series.
The Business Journal Roundtable series is sponsored by Advanced Technology Partners.